Welcome back to the deep dive. We are really getting into it today with a situation that honestly could affect homeowners anywhere. What happens when the people meant to protect your community assets are, well, maybe involved in giving them away?
It's a tough scenario. And today we're focusing on a very specific case, the VVARWA Association, their builder, and what looks like a pretty significant breach of trust involving common property.
Yeah, we're talking potentially millions in lost value here, a serious failure of what's called fiduciary duty, and what the source material suggests is an accounting cover-up tying it all together.
That's right. And our sources, mainly this detailed legal analysis commissioned from within the community, they really lay it all out. It's like a roadmap, not just showing what went wrong, but crucially, how the community might fight back civilly through regulators, maybe even criminally.
So our mission for you listening is pretty clear. We want you to understand how something seemingly straightforward, like selling a piece of land, can just spiral into this complex legal and ethical mess. We're going to unpack four main angles here. The property getting reclassified, the whole fiduciary duty breakdown, this concept of unjust enrichment, and yeah, even potential criminal trouble for those involved.
Let's dive in. Okay, so to really get this, we need to picture the start. You've got this community, 78 owners in total, some villas, some apartments. And initially, the builder set aside 8 extra bits of land, adjacent plots, specifically for 8 of those owners.
Right, like optional extras. If
Yeah.
you wanted that extra garden space or whatever, you paid the builder for it separately.
Exactly. But here's the first critical point. Those 8 people, the ones offered the land, they either couldn't or, well, they just refused to pay for those extra plots. They backed out of that specific part of the deal.
Okay, so the builder's left with these 8 unsold pieces of land within the community. What happens then? They can't just leave them empty, can they? Especially if they're sort of mixed in with everything else.
Well, this is where the builder made a really key move. Since the original 8 hadn't paid, the builder took those plots off their individual accounts or allotments. And then this is the part that changes everything legally. They reclassified those plots as common area.
Ah, okay. Let's pause there because that reclassification, that seems to be the moment everything pivots, right? Designating it common area isn't just semantics. It has, like, real financial consequences for everyone.
Huge consequences.
Yeah.
Because the instant it's labeled common area, the cost associated with that land, acquiring it, maybe developing it, whatever costs were sunk into it, gets, the term used is loaded into the common area cost of the whole project.
Meaning the price tag for those 8 unwanted plots basically got spread across the entire community's contributions.
Precisely. All 78 owners, including the original 8 who didn't pay for them individually, ended up subsidizing and paying for this land through their overall project contributions. It became a collective asset, funded collectively.
So that's who paid for the land, the community, all 78 owners.
Yes. It stopped being the builder's private inventory to sell and fundamentally transformed into community trust property.
And that sets the stage for the financial injury that unfolds down the line, doesn't it?
Absolutely.
Okay, so we've established the land is now common property, paid for by everyone. Fast forward, and the source mentions this huge gap, something like 12 years pass after this reclassification. What happens next is, frankly, kind of hard to believe.
It really is quite something. After about 12 years, those same 8 owners, the ones who originally refused to pay for these plots, they were suddenly allowed to buy back these exact pieces of land, which were, remember, common property by now.
Right, and here's the kicker, the part that just screams something's wrong, the price. They didn't pay what the land was worth now, did they?
Not even close. They were allowed to buy it not at the current market value, land in a developed, established community after 12 years, but at the old original allotment rate, the price from over a decade earlier.
Wow. Okay, just to make that concrete for everyone listening, imagine finding something valuable today, maybe a collector's item or, land, and being told you only have to pay the price listed in a catalog from, say, 2012. The gain would be enormous. What does 12 years typically do to property value?
Well, real estate appreciation can be significant, even a modest few percent a year, compounded over 12 years.
Yeah.
It adds up very, very quickly. We're potentially talking manifold increases in value. And legally, the community, having funded and owned that land, should have been entitled to every single bit of that appreciation.
But instead, because the builder sold it back to these 8 individuals at that ancient price.
Exactly. That huge chunk of value, the entire capital gain accumulated over 12 years, effectively got siphoned off. It went straight into the pockets of those 8 individuals, completely bypassing the association's funds.
At the direct expense of the other 70 owners who also paid for it initially.
Correct. That's the financial injury crystallizing. It's a massive transfer of wealth, essentially. Unjust enrichment is the term that comes up again and again.
So let's go back to the legal status during those 12 years. If the community paid for it, what was that land, legally speaking?
Critically, once the builder reclassified it as common area and crucially recovered the cost from all 78 owners, it wasn't the builder's to sell anymore, it became community property. Legally, it's often referred to as trust property, held by the builder initially and then the association, in trust for the benefit of all members.
Held in trust. So the builder didn't actually have the power to just sell it off like it was leftover stock.
That's the core legal principle here. Rule against alienation.
Yeah.
You generally can't sell off common property once the community is formed and the costs are sunk. And certainly the association's leadership, the managing committee or MC, or even a vote in a general body meeting, a GBM, they typically don't have the unilateral power to just dispose of common assets, not without very specific legal authority, and definitely not without getting full, fair, current market value for the community.
So the implication is that sale back to the original 8 at that ridiculously low historic price. It's what the memo calls prima facie ultra vires. Let's break that down. Prima facie ultra vires. What's that mean in plain English?
It basically means, on the face of it, just looking at the basic facts, the action was beyond the legal powers of the people involved. The builder sold something they no longer had the authority to sell independently, and it looks like the association leadership went along with or enabled the sale of an asset they were supposed to protect.
Okay, and that leads right back to this unjust enrichment idea. Those 8 owners got a fantastic deal, subsidized by everyone else.
Absolutely. The legal memo describes them as beneficiaries of an inequitable preference. It really is presented as a textbook example of unjust enrichment taking value that rightly belonged to the community pot.
Okay, let me play devil's advocate for a second.
Oh.
What if the argument is, look, we didn't steal it, the general body meeting voted on it, maybe they approved the deal. Does a majority vote somehow make it okay?
That's a really important point and a common misconception in community governance. There's a limit to majority rule. A resolution passed by members, even a majority, cannot legalize something that was illegal or ultra vires to begin with. You can't vote to approve giving away common property at a fraction of its value. Majority consent doesn't override the fundamental property rights held in trust for all members, including the minority.
So even if there was some kind of vote, it wouldn't cleanse the transaction if the underlying deal itself, selling common property way below market value, was legally flawed from the start.
Exactly. The legal problem was baked in the moment that historic price was used for common land. Precisely. And, the fact that this transaction even happened points fingers directly at the community's own leadership at the time. The sources suggest the managing committee, the MC, or the association leaders didn't just stand by passively. They seem to have permitted, maybe even actively acquiesced in this deal. They took a payment for it.
Right, they accepted money. But, critically, not nearly enough money, and the way they accounted for it is, well, it's highly questionable. The association apparently received 52 lakh from the builder relating to this land transfer.
Yes, and here's where the narrative shifts towards potential deliberate concealment. That 52 lakh, when it hit the association's books, wasn't recorded as, say, proceeds from sale of common land parcels. It was labeled very specifically as refund of project money.
Okay, refund of project money. Why is that label such a red flag? Why not just be transparent about selling the land, even if the price was bad?
Because calling it a refund of project money appears to mask a completely separate and very significant issue. The builder had another major financial obligation to the association, something usually mandated by law. It's called the Corpus Fund.
The Corpus Fund, can you quickly explain what that is for listeners who might not be familiar?
Sure. Think of the Corpus Fund as the community's long-term financial safety net. It's a substantial one-time payment the builder must hand over to the newly formed association, usually in cash. It's separate from monthly maintenance fees. It's meant for major future capital expenses like, replacing the roof years down the line, major structural repairs, big legal fights, that sort of thing.
Okay, so the builder owed the association a big chunk of cash for this legally required Corpus Fund. And maybe they didn't want to pay it all, so instead of handing over cash, they used the community's own land.
That's exactly what the analysis suggests. This undervalued sale of the common land the community had already paid for 12 years prior, was allegedly used as a kind of illegal surrogate or offset against the builder's separate duty to pay the cash corpus fund. They essentially tried to settle a cash debt using the community's own assets, and undervalued assets at that.
Wow. That's some serious financial maneuvering.
Yeah.
So the community should have received two things: the fair market value for selling its land and the full cash payment for the corpus fund. Instead, they got this one, smaller payment, 52 lakh, which was then mislabeled to make it look like just balancing the books.
That's the core allegation, yes. Right. Booking that 52 lakh as a refund of project money is flagged as a deliberate mischaracterization.
Yeah.
It hides the real transaction, selling off common property below value to let the builder off the hook for a separate cash liability. The legal memo explicitly calls it an attempt to legitimize an illegal alienation by coupling it with a non-monetary settlement. It smells less like an error and more like, well, a structured deception.
This definitely moves the needle from just bad management into potential breach of fiduciary duty territory for the MC, doesn't it?
Oh, absolutely. The managing committee has fundamental duties to all owners: loyalty, care, obedience, fairness.
Yeah.
Loyalty is paramount. They must act in the best interests of the entire community, not just a select few.
And facilitating a land deal that financially benefits 8 owners at the direct cost of the other 70. How does that square with loyalty?
It doesn't. It's presented as a classic violation. Loyalty demands impartiality. Allowing this undervalued transfer and then allegedly participating in masking it with misleading accounting entries. That points towards a severe breach of fiduciary duty, what lawyers call misfeasance. It suggests they actively failed the trust placed in them.
The source material seems to imply this wasn't just like an oversight or incompetence. Distorting accounts, combined with a huge financial gain for just 8 people. It raises the possibility of something more deliberate, right?
That's the gravity of it, yes. When you see an action that transfers years of accumulated asset value from the collective to individuals, and it's paired with accounting that seems designed to hide it, the analysis suggests this is so egregious, it creates a strong presumption of, well, either collusion or such a gross breach of loyalty that it can't just be waved away as simple negligence.
Okay, so let's talk consequences. What does this legal mess mean for everyone involved? Starting with the 8 owners who, right now, technically hold the deeds to these land parcels they got at a bargain price. Are they safe just because they have a piece of paper, a sale deed?
Normally, a registered deed offers pretty strong protection. Why wouldn't it shield them here?
Because the analysis argues they aren't bona fide purchasers for value without notice. Basically, they likely knew or absolutely should have known the deal was problematic. The land was common area for 12 years. They are the original people who refused to pay the proper price. They benefited hugely from a deal at the community's expense, using a price that was obviously way out of date. They can't really claim ignorance here. Okay, so if they weren't innocent buyers, what's their legal status if a court looks into this?
Their position could be really, really shaky. The legal analysis suggests a court might treat them as constructive trustees. That's a key term. A constructive trust is something the law imposes when someone holds property they shouldn't rightfully have. It basically says, okay, you might hold the title, but you're holding it for the benefit of the person you wronged. In this case, the association.
So it's like the law sees them as holding stolen goods, even though they paid something.
In a sense, yes. And this leads to what the memo calls the ugliest outcome for them. Because the initial sale by the builder was arguably ultra vires beyond their power, a court might not just say, okay, pay the difference. The primary legal remedy, the main thing the association might ask for and get, is a declaration that the sale is void ab initio. Another bit of jargon, but crucial. Void ab initio means void from the beginning, like it never legally happened.
Whoa, okay, that changes everything. If the sale is declared void from the start, it's not about damages, it's about unwinding the whole thing.
Exactly. It could mean the court orders the 8 owners to reconvey the parcels back to the association. They would lose the land entirely, because the court would essentially say they never got valid legal title in the first place. The risk isn't just paying more money, it's losing the asset completely.
Grim prospect for them.
Right.
Now, what about the builder, the one who seems to have orchestrated this whole thing? What kind of liability are they looking at?
The builder's facing a stack of potential liabilities. The big one is ultra-virus disposal of common property. They sold something they arguably didn't have the right to sell anymore. Once that land became common area 12 years ago and the cost was recovered from everyone, their power to just sell it off disappeared. They were holding it in trust. And then there's the corpus fund issue, using the dodgy land deal to supposedly offset their mandatory cash payment for the corpus fund. That ties them directly into both the civil claim for the missing money and potential criminal issues. They failed a statutory duty.
The analysis mentions criminal angles. That sounds serious. What specific charges could realistically be brought?
Based on the facts presented, the entrustment of community property, the alleged dishonest diversion of significant value, and that specific accounting entry used to cover trackers, the potential charges mentioned are serious. Criminal breach of trust, cheating, maybe conspiracy to commit these acts, and specifically falsification of accounts.
That falsification of the 52 lakh entry, labeling it a refund, seems like it could be the smoking gun for intent, right?
It certainly looks like strong evidence of intent, yeah? Because it's just a deliberate attempt to mislead, to hide the true nature of the transaction. An honest mistake in accounting gets corrected. Systematically mislabeling a land sale to disguise settling a debt suggests mens rea, or criminal intent, to defraud the community or distort its financial position.
Okay, beyond the courts, what about regulators? Bodies like RERA or the Apartment Authority, can they step in?
Yes, and that's often a faster route. Regulatory bodies, like the Real Estate Regulatory Authority, or ERA, or the Local Registrar of Societies, or Apartment Authority, they have real teeth. They can launch investigations, they can order a forensic audit, which would be crucial here, to nail down the money trail and the accounting issues. They can slap penalties on the builder, and, importantly,
Yes.
for serious governance failures, they often have the power to supersede the managing committee, kick them out, and appoint an administrator.
Wow, replacing the MC. That would be huge for the 70 owners if the current committee is blocking action.
It's like hitting a reset button.
Hmm.
An independent administrator can then pursue the legal remedies without any internal conflict of interest.
One last thing on this fallout, the 12-year delay. Does the fact that so much time passed weaken the case? Can the builder or the 8 owners just say, hey, you waited too long, statute of limitations?
Delay is always a factor the other side will raise, definitely. But the legal analysis is pretty firm that delay doesn't automatically legitimize an illegal act, especially concerning trust property. Courts often grant relief if there's a continuing wrong, like the land is still wrongly held, or if there was active concealment of the facts. And crucially, with trust property, the law generally holds fiduciaries to a much higher standard, and limitation periods might start only when the fraud is actually discovered, not when the act happened, especially if the wrongdoers were in charge. So how does the community actually fix this? The source material lays out a clear, multi-track strategy. It has to start with getting their own house in order, governance-wise.
Makes sense. You need to take back control internally before you can effectively fight externally. How do they kick that off?
The first big step is calling a special general body meeting, an SGBM, specifically to address this crisis. And at that meeting, they need to pass some absolutely critical resolutions to get a ball rolling legally.
Okay, what are the must-have resolutions?
Number 1, absolutely essential. Appoint an independent forensic auditor, not their regular auditor, someone completely neutral, tasked specifically with digging into the whole land reclassification, the pricing, tracing that 52 lock, and figuring out the exact corpus fund shortfall. Get the real numbers. Number 2, the SGBM has to formally mandate a restatement of the association's accounts. That misleading refund of project money entry needs to be corrected to accurately reflect what happened in undervalued sale of common assets. Clean up the books.
And what about protecting the land itself while all this is happening? Can they stop the 8 owners from trying to sell it again?
Yes. Crucial preservation steps. The SGBM should resolve to put a complete standstill on any further dealings with those disputed parcels. No sales, no mortgages, nothing. And then immediately, the association needs to file legal notices like caveats with the local land registry office. This acts as a red flag, warning any potential third-party buyers and effectively freezing the title so the 8 owners can't offload the problem while the dispute is ongoing.
Okay, internal cleanup and preservation done. What's track 2? The direct civil action. How do they go after the builder and the 8 owners?
Track 2 is serving them with a formal legal demand notice. It basically says, here's what you did wrong, here's the evidence, and here's what you need to do to fix it within, say, 15 or 30 days. The notice has to demand one of 2 specific outcomes.
And those outcomes are?
Option A, the ideal one, reconveyance. Give the land back. Transfer the parcels back to the association, making them common property again, as they should be. Completely undo the sale. Option B, the monetary fix. The 8 owners must collectively pay the differential value. That means the full market value of the land at the time they bought it back, minus the small historic price they actually paid, plus reasonable interest for the years the community lost out. This money goes straight into the association's corpus fund. If they refuse to comply with the notice, then the next step is litigation. Filing a civil suit seeking that court declaration that the sale is void or voidable and a judgment forcing them to pay the shortfall based on unjust enrichment, that's where you really bring the legal pressure.
Right. Now, tracks 3 and 4 were about regulatory and criminal pressure. How do those help alongside the civil suit?
Track 3, the regulatory route, is often quicker and cheaper initially, filing formal complaints with RERA, or the registrar, highlighting the breach of fiduciary duty by the MC and the ultra-vires sale by the builder. You specifically ask the regulator to investigate, order that forensic audit, and maybe supersede the MC. This puts official pressure on everyone.
And track 4, the criminal complaint, you said that's like the nuclear option.
It is, but it can be incredibly effective leverage. If the forensic audit confirms things like deliberate account falsification, filing a police complaint, an FIR, alleging criminal breach of trust, cheating, etc., raises the stakes dramatically. Nobody wants a criminal investigation hanging over them. Even if a conviction is difficult, the threat often forces serious settlement talks much faster than a civil suit alone. Personal liability becomes very real. And intertwined with all this is track 4, internal renewal. If the current MC is part of the problem or is just dragging their feet, the members need to use their rights under the community's bylaws to vote them out. Elect new ethical committee that's actually committed to recovering the assets. #tag defining fair resolution.
It's important, after all this complexity, to be really clear on what a win looks like. What does the source material define as a truly fair resolution for those 70 owners who lost out?
The primary goal, the best outcome, is always restoration. That means reconveyance, getting the actual land back into the association's name as common property. That way, the community gets the asset itself, plus all its future potential value. That's the gold standard.
What if getting the land back is just practically impossible? For some reason, maybe buildings have gone up or it's legally too tangled. What's the fallback monetary solution?
If reconveyance isn't feasible, then the monetary resolution must make the community whole financially. The 8 owners have to cough up the full difference between the fair market value back when they bought it and the discounted price they paid. Plus, importantly, reasonable interest for all those years the money was missing from the community coffers. That payment goes directly to restore the association's corpus fund. No discounts.
And just to be crystal clear, whatever the 8 owners pay, the builder still has a separate debt to settle, right?
Absolutely critical point. The builder's obligation to pay the original corpus fund shortfall is separate and distinct. Any money recovered from the 8 owners for the land value doesn't let the builder off the hook. The builder must still pay whatever cash amount was originally missing from the corpus fund in full. This ensures both wrongs are righted, the land value is recovered, and the community's foundational fund is properly established with cash, not dodgy offsets. #tag outro pace.
Well, this has been quite the deep dive. It's frankly disturbing, but also fascinating to see how governance failures and financial maneuvering can intersect to basically strip assets from a community and hand them to a few individuals. We've seen a deal that seems legally flawed from the start, transferring potentially millions in value, all disguised by an accounting entry and a price tag from the past.
Yeah, and I think the biggest takeaway for anyone listening, maybe facing something similar in their own community, is that this kind of alleged illegality doesn't just fade away or become legitimate because time passes or because people stay silent. The analysis underscores that you need prompt, documented, multi-front action. Start with that independent audit, get the facts straight, issue those legal demands. Don't let the complexity paralyze you. Protecting common property rights requires vigilance and sometimes a real fight.
It really throws the whole purpose of community governance into sharp relief, doesn't it? I mean, if the managing committee's core job is to protect the community's collective assets, to uphold that fiduciary duty, what happens when that very committee seems implicated in giving away those assets and maybe even covering it up?
It raises a fundamental question, doesn't it? When the guardians themselves are compromised, where does the community turn first? Do you put your faith in the sometimes slow wheels of justice in the courts to claw back the assets? Or do you first go to the ballot box, exercise your internal political power to regain control of the leadership and steer the ship yourself?
A tough question indeed, something for you to think about. That's all the time we have for this deep dive. Thanks for joining us.